Question 386. A real estate broker must retain copies of her listings, deposit records and receipts going back at least A. 1 year, B. 3 years, C. 5 years, D. The law doesn't specify years, just states records should be preserved for a good amount of time. Correct answer is B. 3 years. California real estate law requires brokers to keep copies of all listings, deposit records, receipts, and transaction documents. This retention period is a minimum of 3 years, starting from the transaction date or the listing's expiration. This requirement ensures that there is a sufficient record of the broker's activities for potential audits, investigations, or legal proceedings. While good business practice might suggest retaining records for even longer, the legal minimum in California is 3 years. Question 387. Regarding a land contract, during the period in which the vendee, purchaser, is still making installment payments and title has not yet been transferred, the vendor, owner, may A. Encumber the property with a mortgage after getting permission from the vendee, B. Encumber the property with a mortgage without getting permission from the vendee. C. May not encumber the property with a mortgage under any circumstances, D. None of the above. Correct answer is B. Encumber the property with a mortgage without getting permission from the vendee. In a land contract, also known as a contract for deed or installment land contract, the vendor retains legal title to the property until the vendee has made all or a substantial portion of the installment payments. The vendee holds equitable title and the right to possess and use the property. As the legal owner, the vendor technically has the right to encumber the property with a mortgage. However, this action is subject to the terms of the land contract and the vendor's obligations to the vendee. If a vendor mortgages property without the vendee's knowledge or consent, and this endangers the vendee's right to full title upon payment completion, e.g., through foreclosure, the vendor may be in breach of the land contract. This action can jeopardize the vendee's equitable interest in the property. The vendee could potentially sue the vendor for breach of contract and seek remedies such as specific performance, forcing the vendor to convey title, or damages. The specific terms of the land contract are crucial. Some land contracts may explicitly restrict the vendor's ability to encumber the property without the vendee's consent. It would be highly unethical and generally poor practice for a vendor to encumber the property with a significant mortgage during the term of a land contract without informing the vendee. Such actions could be seen as a breach of the implied covenant of good faith and fair dealing. While the vendor legally holds the right to mortgage the property, doing so without the vendee's consent can lead to severe legal repercussions. This is especially true if the mortgage puts the vendee's equitable interest and their future right to clear title at risk. Option B is technically correct in terms of the vendor's legal ownership rights. However, it's a risky action that could lead to a breach of contract if it negatively impacts the vendee's position. Option A is a much safer and more ethical approach for a vendor to take if they need to mortgage the property during a land contract. Option C is incorrect because the vendor retains legal title. Question 388. A landlord and lessee agree on terms of a 2-year lease for an apartment rental. The landlord signs the lease and sends it to the lessee, who receives it, moves into the apartment, sends the landlord 3 months' rents, but never sign the lease. Upon the completion of 3 months, the tenant decides to disregard the terms of the lease and move out. Given this scenario, a court will likely decide that A. The tenant is bound by the lease because he moved in and paid rent in advance. B. Since the tenant never signed the lease, he is not bound by it and can move out when he pleases. C. The tenant is bound by the lease because only a lessor, the landlord, need sign a lease. D. None of the above. Correct answer is A. The tenant is bound by the lease because he moved in and paid rent in advance. While the tenant didn't formally sign the written lease, their actions unequivocally demonstrate acceptance of its terms. Moving into the apartment and paying rent for 3 months are clear indicators that they agreed to the landlord's offer of a 2-year lease. This is known as acceptance by conduct or implied acceptance. The tenant's payment of rent and occupancy of the premises constitute partial performance of the lease agreement. Courts often recognize partial performance as sufficient to enforce a contract, even if it wasn't formally signed by all parties. Question 389. The term fiduciary does not apply to the following relationships between parties: A. Listing broker to seller. B. Truster to beneficiary. C. Attorney to client. D. Agent to principal. Correct answer is B. Truster to beneficiary. A fiduciary relationship is one where one party, the fiduciary, has a legal or ethical duty to act in the best interests of another party. This relationship involves trust, confidence, and good faith. Let's examine each option. A. Listing broker to seller. A listing broker acts as the agent of the seller and owes them fiduciary duties, including loyalty, obedience, disclosure, confidentiality, accounting, and reasonable care and diligence. C. Attorney to client. An attorney has a strict fiduciary duty to their client, acting in their best legal and financial interests. D. Agent to principal. The relationship between an agent and their principal is inherently fiduciary. The agent is authorized to act on behalf of the principal and must do so with the principal's best interests in mind. B. Truster to beneficiary. In a trust, the trustee has a fiduciary duty to the beneficiary, managing the trust assets in the beneficiary's best interest. The truster is the person who creates the trust and transfers assets into it. The relationship between the truster and the beneficiary is not typically described as a direct fiduciary relationship in the same way as the others listed. The truster establishes the terms of the trust, and once established, the fiduciary duty lies with the trustee. Therefore, the term fiduciary does not directly apply to the relationship between the truster and the beneficiary. The fiduciary duty exists between the trustee and the beneficiary. Question 390. The buyer's good faith deposit for the sale of 1 to 4 unit, owner-occupied residential property can be used for liquidated damages, but only if A. The total amount being forfeited is not more than 3% of the purchase price. B. The contract was recorded. C. The contract contains a liquidated damage provision in large type separately signed and initialed by both parties. D. Both A and C. Correct answer is D. Both A and C. Here's a breakdown of the requirements for using a buyer's good faith deposit as liquidated damages in the sale of a 1 to 4 unit, owner-occupied residential property in California. A. The total amount being forfeited is not more than 3% of the purchase price. California law generally presumes that a liquidated damages clause is reasonable if the amount forfeited is no more than 3% of the purchase price. Amounts exceeding 3% are presumed unreasonable and unenforceable unless proven otherwise. C. The contract contains a liquidated damage provision in large type separately signed and initialed by both parties. California law specifically requires that a liquidated damages provision in a residential purchase agreement be 1. Printed in at least 10-point bold type or in contrasting red print in at least 8-point bold type. 2. Separately signed or initialed by each party to the contract. Recording the contract is not a requirement for a liquidated damages clause to be enforceable. Question 391. If a plaintiff wins a lawsuit based on the 1968 Civil Rights Act, the following remedies against the defendants are available, except A. Money damages for plaintiff's pain and suffering. B. Suspension or revocation of the license of the real estate agent whose unlawful actions led to the lawsuit. C. Money damages covering plaintiff's attorney fees. D. Punitive damages designed to discourage unlawful actions from recurring. Correct answer is B. Suspension or revocation of the license of the real estate agent whose unlawful actions led to the lawsuit. The 1968 Civil Rights Act, Fair Housing Act, primarily focuses on providing remedies to the victim of discrimination. The direct sanctions against a real estate licensee typically fall under the jurisdiction of state real estate licensing authorities, not directly as a remedy awarded by a court in a Civil Rights Act lawsuit. Compensatory damages, including those for emotional distress and pain and suffering caused by discrimination, are often awarded in Fair Housing Act cases. The Fair Housing Act allows prevailing plaintiffs to recover their reasonable attorney's fees and costs. This is a crucial element in ensuring access to justice for those who have experienced discrimination. Courts can award punitive damages in Fair Housing Act cases to punish defendants for egregious or intentional discriminatory conduct and to deter future violations. Discriminatory actions by a real estate agent can result in disciplinary measures against their license by the State Real Estate Commission through an administrative process. However, this licensing action is distinct from the remedies a plaintiff may receive in a lawsuit filed under the 1968 Civil Rights Act for the discriminatory conduct itself. Therefore, while both address discriminatory behavior, they operate through separate legal and administrative channels. The remedies in such a lawsuit focus on compensating the victim and deterring future discrimination. Question 392. Is the most important factor in determining a property's value? A. Design. B. Location. C. Utility. D. Age. Correct answer is B. Location. This is a long-standing principle in real estate, often summarized as location, location, location. When assessing a property's value, location stands out as the paramount consideration. This single factor encompasses a wide array of elements that significantly impact a property's desirability and, consequently, its price. Aspects such as proximity to employment centers, transportation networks, shopping, and recreational facilities are all tied to location. Furthermore, the quality of the neighborhood, including safety, community amenities, and the prestige associated with the area, heavily influences buyer interest and property values, often overshadowing the specific features of the dwelling itself. Question 393. The value of a property can increase significantly when its neighborhood includes lots and the houses built on them that are mostly similar in size and shape. Describes the A. Principle of substitution. B. First law of housing. C. Principle of conformity. D. Principle of progression. Correct answer is C. Principle of conformity. Principle of substitution states that a buyer will pay no more for a property than they would for an equally desirable substitute property. It focuses on the availability of comparable alternatives. First law of housing is not a recognized principle in real estate appraisal. Principle of progression states that the value of a lower-priced property can be increased by its association with higher-priced properties in the same area. It's the opposite of the principle of regression, where a higher-priced property can be negatively affected by lower-priced ones. Principle of conformity states that property values tend to be highest when there is reasonable similarity in size, style, and age of the homes in a neighborhood. Properties that conform to their surrounding area tend to be more desirable and maintain their value better. Out-of-place properties, overly large, run down, or significantly different in style, can be negatively affected by the surrounding non-conforming properties. Question 394. The following occurs whenever a payment is made for an amortized loan. A. The amount applied to the principal rises. B. There is a balloon payment. C. The amount applied to the principal remains unchanged. D. Both A and B. Correct answer is A. The amount applied to the principal rises. A balloon payment is a large, lump sum payment due at the end of some loans, which is not characteristic of a fully amortized loan. In an amortized loan, each payment is applied first to the accrued interest, and the remaining portion is applied to reduce the principal balance. Over the life of the loan, 1. Interest portion decreases. As the principal balance decreases with each payment, the amount of interest owed on the remaining balance also decreases. 2. Principal portion increases. Since the total payment amount typically remains constant, as the interest portion decreases, a larger portion of each subsequent payment is applied to reduce the principal. Question 395. The types of mortgage default insurance include: A. Partial coverage, B. Full coverage, C. Co-insurance, D. All of the above. Correct answer is D. All of the above. Mortgage default insurance is typically required for conventional loans with a down payment of less than 20%. It protects the lender in case the borrower defaults on the loan, but it does not protect the borrower. Partial coverage covers a portion of the lender's losses in case of default. The specific percentage of coverage will vary depending on the program and the loan-to-value ratio, LTV, of the property. Full coverage covers the lender's losses up to a specified limit in case of default. This limit is typically the outstanding loan balance but may have limitations. Co-insurance is a shared risk arrangement between the lender and a private mortgage insurance company. The lender pays a portion of the premium, and the private mortgage insurance company covers a portion of the losses in case of default. The specific sharing arrangement will vary depending on the program. Another variety of coverage, self-insurance, puts the risk of default with the lender.